This Week in Economics from WBRN Radio and on the Bostonred Network. The date of this episode is the 12th of May, 2019. Last week we spent a considerable amount of time on the annual meeting of Berkshire Hathaway. Berkshire Hathaway, of course, is on the direction of Warren Buffett, known as the Oracle of Omaha. And very interesting. We'll have a few more tidbits, and we have time on that, from the Omaha Herald, which is also owned by Berkshire Hathaway, kind of a roundup of what is going on there and various trends. On this broadcast, we'll be looking at some PCIs from the market people. They are one of the best in the business putting those out. We'll look at several countries here. Let me just get this up on the workstation. We'll look at the Nikkei, Japanese manufacturing PMI, that is also released by ISH market organization here. And we'll look at the first quarter estimates for UK. That's January to March 2019. We'll do a bit of a deep dive on it. And we'll also look at climate change. May curve, the headline from the BBC, may curve growth in UK flying. That's been a very contentious issue. And we'll have, from Bloomberg, we'll talk a little bit about the trade deal, purported trade deal between the U.S. and China. And let's just start this off here with the White House considering an economist named Judy Shelton for the Fed board. This is from Bloomberg. Shelton had been contacted by the White House regarding the position as to fill one or two vacancies on the Federal Reserve Board of Governors. She declined to comment, but on Saturday, thank you, the tweet from Representative Jim Banks, a Republican in Indiana, saying she'd be a great pick for the central bank. She, unlike some of the others, she does have a PhD, but it's in business administration with emphasis on finance and international economics from the University of Utah, not an economics powerhouse for sure. She's currently, and this is very interesting, executive director of the European Bank for Reconstruction and Development. Previously worked for the Sound Money Project, was founded to promote awareness about monetary stability and financial privacy. Sheldon wrote a commentary for the Wall Street Journal entitled "A Case for Monetary Regime Change." She said it was entirely prudent to question the infallibility of the Federal Reserve in calibrating the money supply to the needs of the economy. Put some more as an outline here. Some other characters they came up with was a character named Stephen Moore. He was a political type. His candidacy fell apart. And Herman Cain, who ran for president. And then there's two other characters here, Nellie Langen and Marvin Goodfriend. So these are some of them that have fallen apart. Moore and Cain, of course, exited. And before the current 0-for-4 streak, Trump succeeded in filling 3 posts on the Fed, elevating Jerome Powell, already a governor, to chair, and he evidently would like to get rid of Chairman Powell. And Richard Clarida is the vice chair, and the vice chair for supervision is Randall Quarles. Those are some of what DJ Trump has put on the central bank. We thought we'd get to that first. There obviously be more information on her later. She served as an informal advisor to the Trump administration, so she's not, as one would say, new to the game, period. Let's get to the new release here. This is in the Bureau of Economic Analysis. We fall back on them almost every week. International trade in goods and services. Let me just zip this up. This was released on Thursday, May 9th. International trade in goods and services deficit. The deficit is at 60 billion. That is a plus 1.5%. Exports at 212 billion. That's a plus 1%. And imports at 269 billion. And the next release will come on June the 6th. March exports were 212 billion and 2.1 billion or more than in February. March imports were 262 billion, 8 billion more than in February. March increase in goods and services deficit reflects an increase in goods deficit of 0.5 billion to 72.4 billion, and a decrease in service surplus of 0.2 billion to 22.4 billion. Year-to-year goods and services deficit decreased 5.8 billion, or 3.7% from the same period in 2018. Exports increased at 14 billion, or 2.3%. Imports increased at 8.2 billion, or 1.1%. The 3-month running average, they call it, goods and services deficit decreased by 3.3 billion to 51.1 billion for 3 months ending in March. The average export increased by 2.2 billion to 209.7 billion in March. The average imports decreased by 1.1 billion to 229.9 billion. That was in March. Year over year, the average exports increased at 4.7 billion from March, and the average imports increased at 2.7 billion from March. So let's see. Industrial supplies and materials increased at 1.7 billion. Natural gas liquid increased at 0.4 billion. Fuel oil increased at 0.3 billion. Mineralogical grade coal increased at 0.3 billion. Other petroleum products increased at 0.3 billion. Food, feed, beverage increased at 0.8 billion. Soybeans increased at 0.5 billion. Capital goods decreased at 0.5 billion also. Civil aircraft decreased at 0.7 billion. Net balance of credit adjustment decreased at 0.1 billion. Exports of services increased less than 0.1 billion to, again, the number here is 70.3 billion in March. Maintenance and repair services increased at 0.1 billion. Financial services increased also at 0.1 billion. Transportation decreased at 0.1 billion. Now to the import side of the coin. Imports of goods increased at 2.6 billion to 21.1 billion. That was in March. Import of goods on census basis increased 2.6 billion. Industrial supplies materials increased at 2.4 billion. Crude oil increased at 1.4 billion. Organic chemicals increased at 0.5 billion, and other petroleum products at 0.4 billion. Food and beverage increased at $1 billion, and other food increased at 0.1 billion. Wait a minute, just a second here. Fish and shellfish increased at 0.2 billion. Consumer goods decreased at 0.7 billion. Mobile phones, they call them cell phones, and other household goods decreased at 1.1 billion. Net adjusted payments decreased at 0.1 billion. Import of services increased at 0.2 billion to 47.8 billion. That was in March. Travel for all purposes, including education, at 1/10 billion. Maintenance and repair services increased at 1/10 billion. Insurance services decreased at 1/10 billion. Real goods in 2012 dollars, we moved to 2012 dollars, increased at 0.5 billion to 82.1 billion in March. Real exports of goods increased 1 billion to 151.8 billion. Real imports of goods increased at 1.5 billion to 233.8 billion. Revisions to February's exports were revised up 1/10 billion. Export services were revised up 1/10 billion also. Revision to imports. Import goods were revised up less than 1/10 billion. Import of services were revised up 1/10 billion. Goods by selected countries in billions of dollars, with South and Central America at 4.2, Hong Kong at 2.4, Brazil at 0.9, OPEC at 0.7, Saudi Arabia at 0.3 tenths, as Singapore at 2 tenths. Deficits were recorded in billions of dollars, with China at 28.3, with the EU at 15.8, with Mexico at 8.6. Japan 6.1, Germany 5.7, Italy 2.8, Canada 2.1, Taiwan at 2, and Korea at this is South Korea at 1.8, India also at 1.8, France at 1.6, and the UK at 0.2 tenths. This is surpluses. Deficits with the EU increased 3.4 billion to 15.8 billion in March. Exports decreased 1.4 billion to 27.8 billion. Imports increased 2 billion to 43.6 billion. Balance with Canada shifted from a surplus of 0.5 billion to a deficit of 2.1 billion. March exports decreased by 1/10 billion to 25.3 billion. Imports increased to 2.6 billion. Increased 2.6 billion to 27.5. Deficit with China decreased by 1.9 billion to 28.3 billion in March. Exports increased 1.4 billion to 10.5 billion, and imports decreased 0.5 billion to 38.8 billion imports. And I think we've gotten to the end of the shift here. Yeah, there's a little bit of a name change here. They're talking here about Macedonia replaced with North Macedonia. Upcoming updates to good and service, international trade in goods and services for April 2019, and something else. Anyway, that'll be out on June the 9th. We won't see that until next month, and that will do it for that part of it. Let's go to China. This is from Bloomberg. China names its trade deal price as Trump sets new deadline, and this is on the 11th of May here. China for the first time made it clear that it wants to see from the U.S. in talks in so-called trade war, my words not theirs, laying bare the deep differences that still exist. In a wide-ranging interview with the Chinese media, Li, Vice Premier said in order to reach an agreement, the U.S. must remove all extra tariffs, set targets for Chinese purchase of goods in line with real demand, ensure that the text of the deal is balanced to ensure the dignity of both nations. Liu's free conditions underscore the work still to be done if an accord is to be reached by the two world large economies. The threat was made during the talks on Friday, hours after Trump imposed a punitive duty on 200 billion in Chinese goods. China vowed retaliation but hasn't announced any details yet. However, U.S. officials insist they are working on a deal that would bring an end to what they portray as China's rapid theft of intellectual product. For the interests of the people of China, this is Vice Premier Liu. The people of the U.S. and the people of the world, we will deal with this rationally. But China is not afraid, nor is the Chinese people, adding that China needs a competitive agreement with equity and with dignity. New word they brought in, dignity here, a series of tweets that cheer the market. Trump declared Friday that talks with China had been a candid and constructive. Relations between President Xi, and myself remain very strong. According to Liu, the president, Xi agreed on a number when you meet in Argentina when they met in Argentina in late December to hammer out the truce set out months of negotiation. The amount of China's purchase should be in line with reality. We already talked about that. And it's an election year, of course. And, of course, getting harder. This is the other part. The talks have also amplified the differences that remain between the two governments as they navigate their own domestic politics as well as the growing international rivalry. No doubt about that. The question is, can the Chinese come back and offer enough such Trump can sell it? Well, whether he sells it or not, as they say, blow out that hard. This trade deal will be going on. It will be hammered out. A lot of it is just sheer rhetoric. The whole thing about intellectual product is one of those things that's effectively, we use a non-economic term, silly. Hold tight for volatility of trade turmoil rattles markets anew. This is on the 12th today. This again from Bloomberg. I think we'll look at this article while we are here. Investors are standing by for a fresh bout of market turmoil, and this is one of the things that does cause problems and can cause real problems, period. The standoff between the U.S. and China appears to deepen at the weekend after Trump tweeted again, this time to say the Chinese may have felt they were being beaten so badly in recent talks, something you don't do. Amidst the proposal of retaliation from Beijing, U.S. decision to slap on the tariffs. This is the 200 billion. There, overseas, about 1 billion is a dynamic market fund. This is APM Capital said in an email. The biggest problem is a huge disconnect of what markets have been hoping for and what is actually transpiring. Markets have priced the best case scenario, and the odds are shifting towards the worst case scenario. Chinese response was certainly not what risk markets were hoping there. China is planning on how to retaliate and told Washington that it must remove all extra tariffs. China's demanding the U.S. drop tariffs is setting the stage for a serious face-off. This is from his email here. Economic tensions have now warped into military tensions. One thing to remember here that the whole trade tariff embargo regime by the Trump administration is a political act, and by an inexperienced administration in both macroeconomics and also in all matters political, particularly global matters, has set things at a destructive course, no doubt about it. Forward-looking currency markets are reacting to the proposed Chinese trade surplus falling, and Chinese cooperation with the 840 billion of onshore foreign exchange loans preemptively buying dollars. Similar behavior last year caused the exchange to rise, from 6.25 to 6.295. The dollar strengthened against the yuan signals a greenback should remain strong versus the euro and other currencies. A sharply higher greenback fueled by trade was a key threat to U.S. investors, raised on the Net West team visit to clients in New York, Seattle, and in California. For the Fed is unwilling to consider easing money, that's quantitative easing it's called. And another chief strategist here at Dubai, in Dubai's capital anyway. Concerns for new tariffs will be borne by U.S. consumers as prices increase, lifting inflation. Now this is where it gets very dicey above the Federal Reserve's line of 2%. That may change the current stance on interest rates in the U.S. from hold to cut to become hold to raise by the year in early 2020. Now, this is one of the things in a modern capitalist society. These tariffs are destructive in that they will eventually be passed on to consumers, wholesalers, etc. in the channel. And we can see that particularly in components, which we source from time to time, electronic components, computer components, I should say. I do believe it undermines this negotiation term and kills any chances of a possible compromise to reach privately before going public, and that is a big problem and always has been. Progress, then he goes on to say, this is by Hassani Malik, is a Dubai-based head of equity strategy at Telmeyer. Progress in U.S.-Chinese talks is always going to be partial and temporary because of the clash of interests at stake. The setback in negotiation will hurt global growth expectations and pressure emerging market assets. For those economies with manufacturing integrated with China, it is worse, but it also remains the case that rival manufacturing exporters to China, such as Bangladesh and Vietnam, should benefit over time from the redirection of purchase orders and greater margin additions. From someone else here, Raffaele Bintoni. This is Gulf investment in Kuwait City. Investors who are exposed to emerging market assets should protect their portfolios by switching from country to country that are already suffering from significant inflation pressures, heavily dependent on foreign currency debt. And he names the Philippines, Indonesia, Malaysia, India, Turkey, Brazil, and Argentina. Argentine economy is a basket case at this point to countries where interest rates are always low and there's more room for easing of monetary policy to grow. And named there is South Korea, Thailand, and Mexico. U.S. Treasury would be one of few safe havens still cheap in terms of real rates. Seeing the upside for U.S. investment grade corporate bonds, which remain more cautious on U.S. high yield debt, which is more correlated to performance by equity markets. Expect the dollar, the yen, the Swiss franc to benefit from demand for haven assets. All right, let's go to some PCIs here. We'll do the Nikkei. PCI rises to 3-month high as decline output and demand ease. And the key points here is the PMI. This is a Nikkei to 50.2 above 50 is considered good. Orders and outputs continue to fall, but to a lesser extent. Employment growth picks up while business confidence improves. The latest survey data from Japanese manufacturing sector reveals that the headline PMI returned to expansive territory during April. The improvement partially reflects a weaker downturn index. Indexes two components, and output and new orders a positive sign came from employment, which rises at a strong pace, but both stocks and qualities of purchases fell as firms looked to cut costs. You're going to see more of that in many of these economies. Headline Nikkei Market Manufacturers Index is a composite, a single-figure indicator of manufacturing performance. It ticked to 50.2 in April from 49.2 in March, to its highest mark since January, the beginning of the year. As has been the case since the turn of the new year, new orders placed with Japanese manufacturers fell during the latest survey period. The continual downturn in sales was attributed to underlying weakness in demand, as well as a lower investment and lower orders for the export market. However, the decline lost momentum and eased since March, split by market groups, capital groups. Producers recorded the steepest fall in demand. Meanwhile, new business from abroad fell at a slightly steeper pace in April, with demand conditions remaining challenging regarding further cutbacks to production at the start of Q2. With although the latest data pushes the current period of contraction into the 4th month, the rate of decrease slowed to a modest pace that wasn't as weak since January. The latest survey reveals that companies stepped up their efforts to clear excess stock, but pre- and post-production and inventories were depleted in April, reflecting the recent soft patch in order book volume. Finished goods were taken from warehouses and used to fulfill outstanding orders, contributed to the quickest drop in backlog work since June of 2016. In line with the trends as seen in stock purchases, input buying were reduced by Japanese goods producers. Again, lower near-term output requirements prompted firms to scale back of their input purchases. Needlessly, firms reported stronger efficiencies. Losses were across their supply chain, according to anecdotal evidence. Operating costs increased during the latest survey period, with firms attributing the rise to greater expense for fuel, labor, construction materials, and metals. However, the rate of inflation was the weakest since August of 2017. Output charges were raised by a broadly similar pace in March. Business confidence improved during April, building out of gains in March and hitting a 5-month. Commentary here by Joe Hales. He's an economist at ISH Market. A pickup in Japanese manufacturing PMI to a 3-month high will be a welcome sign that the recent drop in momentum has potentially subsided. New orders and outputs both declined in April, but to a lesser extent, while business confidence continues to climb from a near record low in February, given the difficulties faced by firms in semiconductors, automobile-related industries in recent months. it bodes well that the anecdotal evidence indicates that the strong optimism was a part driven by more upbeat forecasts in key Asian industries. Now, the German construction PMI activity ticked down and amid slow rise in orders there, though continuing to gain in April. The German construction sector showed a loss of momentum from the strong rates of expansion recorded at the end of the opening quarter. The latest PMI survey, that report reveals slower increase in activity, employment, and buying levels as new orders rose at its weakest pace for 6 months. Cost pressures remain elevated by historic standards, although the rates of inflation in both input price and subcontract charges retreated further from their highest. The headline season adjusted German construction PMI slipped to 53 in April from a March high of 55.6. The latest reading was the lowest since January, but still comfortably higher from the running average of 47.8. That's since 1999. Behind the increase in total industry activity in April was sustained growth in housing and commercial buildings. However, despite remaining solid overall, the respective rates of expansion were the weakest for 3 months. Civil engineering activity, meanwhile, fell in April, as well as indicating a slower increase in activities. Latest data also signaled a further weakening of the pace of new orders. Growth of German construction down from a 13-month high in February. And let me just quickly see what else we have. We have pinned these anyway. April's cost pressures across the construction sector eased further by higher levels observed around the turn of the year, but its weakest rate since May of 2018. Construction supply chain, which is always important, the supply chain, meanwhile remained stretched in April. Around 1/3, 31% of the survey firms reported a lengthening of input lead time versus 4% noting an improvement. And the commentary here from Phil Smith. German construction sector hit a bit of a speed bump in April as growth slowed, falling from a 14-month high of 55.6. The upturn in residential building remains a real bright spot across German construction sector amidst a strong demand for housing and the supply of supportive credit conditions. Commercial activity grew at slowest rate for 3 months, but it was a modest decrease in civil engineering activity that was perhaps the biggest disappointment. Capacity constraints remain an issue across the construction sector, with firms reporting a drift of subcontractors and increased wait time for inputs, although they look to be having a warmer impact on costs. Rates of inflation in purchase prices and charges leveled by subcontractors have eased further from their recent highs, which is probably a reflection of developments on both supply and demand side. Very, very interesting there. Now, this is a global market sector PMI from ISH, Global Transportation Business Activity Index, at 37-month low. That's 50.2. Chemical production rises, but metal and mining decreased. The global PMI index indicates are compiled from responses to questionnaires sent to product managers in the global survey panel that covers 27,000 private sector companies in more than 40 countries. Indicates are available for basic materials, consumer goods, consumer services, financial care, healthcare, and technology. I won't name all of these. Global transportation activities stagnated in April, with business activity leveled at a 34-month low at 50.2. The sector in the whole part of the widening industrial group, where output rose at its slowest rate in 32 months. Chemical output rose at a stronger rate, lifting the overall basic material output higher for the first time in several months, despite a further drop in metals and mining. The third consecutive sector, forest and paper, registered broadly no change there. Global auto and auto parts sector remains in contraction, and this affects the automobile industry worldwide. Other finances recorded strong growth of all in April, followed by salt-wind services. The rate of expansion were the fastest in 10 and 12 months respectively there. Now, let's go back to the UK. This is January to March. The final estimate of goods and domestic product, GDP, here this is in the UK. During the final quality assurance of the Blue Book, quarterly national accounts data sets, an error was discovered in the general government's final consumption expenditure. The error reflected 2005 data included in the report. Growth by 1.7 percentage points from 2.3 and 2.4. There's no impact on headline GDP in this particular report. The main points: gross domestic product, this is in the UK, in volume terms was estimated to increase at 0.5 in Q1, that's January to March of 2019, having slowed to 0.2 growth in the previous quarter. Compared with the same quarter a year ago, the UK GDP increased by 1.8% to Q1, that's January to March, from 1.4% in the previous period. That would have been Q4 of 2018. Growth in the service sector, I don't know why I'm doing this, slowed to 0.3 in the latest quarter, while there was a noticeable pickup in growth in the production sector, driven by growth of 2.2% in manufacturing output. Private consumption, government consumption, gross capital formation contributed positively, while net trade contributed negatively to GDP growth. That's seen in various nations. The trade deficit widened to 3.4% of a normal GDP in the quarter one, Q1 we call it. When unspecified goods are excluded, the deficit widened to 2.3 of the normal GDP figure. Gross fixed capital formations increased by 2.1 in the latest quarter, with strong growth in government investment. Business investment increased by 0.5 in Q1, following a contraction in Q4, that would be 2018. Things you need to know: gross domestic product is the main indicator of economic performance. This is from the UK. International Financial Reporting Standards, a new reporting, this is in January this year, 19. A new reporting standard took effect for those businesses using accountancy framework. International Financial Reporting Standards leases bring the report of operating leases on the balance sheet. That has an impact on how businesses have reported their fixed assets. Won't spend very much time on that. The UK economy grew at 0.5 in Q1 of this year. January to March, having slowed to 0.2 in Q4 of last year. There's some redundancy here in this. I will just attach this particular situation here, and you can kind of see what has happened. In 2017, the GDP was at 1.8, 2018 1.4, and goes quarter by quarter. For example, in Q1 of 2017 was 0.4. In Q2 it was 0.3 as 2017. 0.5 in Q3 and Q4 at 0.4. In 18 at 0.1, that was in the first quarter of 18. 0.4 in the second quarter, 0.7 in the third quarter, and 0.2 in the fourth quarter. And now we're at 0.5 in this quarter. That is the UK. Growth in production and construction output increased as service sector growth slows. The gross domestic product at 0.5. Production output increased at 1.4 in Q1, in which manufacturing output increased by 2.2. Service growth slowed 0.3 in Q1, while construction input increased by 1%. Output of agriculture, forest, and fishing fell to 1.8. There's a negative contribution there. I actually like the way they set it up here in their report, a little more than the one in the U.S. Service sector growth slows despite strengthening in wholesale, retail, and motor trade. Following a weak picture in Q4 back to 18, in which all four areas of production experienced a fall in output. Q1 at 1.4%, predominantly driven by manufacturing output, which increased 2.2. And again, they refer to the market manufacturing PMI for March of 2019. While a record high in manufacturing activity due to companies stepping up production to build up inventories in advance of Brexit, the rate of investment increase was the highest for the G7 countries. Recently there has been much interest in the extent to which stock buildup has been taking place in the UK. This reference to when a business increased holdings in intermediate or finished goods, which is typically in response to unexpected shock demand. There has been a concern that there will be disruptions at the UK border, and there has been external survey evidence that points to sharp upticks in business increasing their stocks because of this situation. For instance, the latest Bank of England agent summary shows that around half of all respondents have been building up inventories as part of their Brexit contingency plan, while almost 1/3 of respondents in the latest decision makers panel survey reported an increase in stock levels. It's difficult to unpack how much the increase in manufacturing output in Q1 might reflect the increase in domestic output produced by UK manufacturing in response to stockpiling demands and foreign manufacturers. There's been widespread strengthening across the majority of manufacturing industries in Q1, most notably occurring in relatively volatile pharmaceutical sector, which increased by 4.9 in this quarter. This is mainly driven by the growth in exports of pharmaceutical products, some of which were likely in anticipation of the original Brexit deadline. Now that's extended to March. Manufacturing of food and drink recovered from a fall in Q4, driven by an increase in manufacturing of alcohol products, probably to get through Brexit. The manufacturers of transportation equipment also recovered from a fall in the final quarter of 2018, increasing by 9/10. Manufacturing and quarrying production also bounced back, increasing by 2% from a previous fall. This increase stems predominantly from relatively new oil field maturing in production capacity, led to an increase in output the first 3 months. Following a weekend in 2018, construction output recovered in the first quarter by 1% there. The expenditure measures of domestic GDP increased by 5/10. Private consumption and government consumption, capital goods expenditure formations, that's GCF, contributed to positive growth there. And let's see. Following recently subdued 2018 household consumption increased at 7/10 in the 3 months of this year, although when compared with the same quarter a year ago, growth remained subdued at 1.9%. The latest Bank of England agents and summary of business states the uncertainty about Brexit and the widening and the wider economy weighted on spending. The consumer confidence index remains unchanged at a negative 1.3 in March there. Government consumption increased by 1.4, following a growth of 1.3 in the fourth quarter. Government consumption and investment figures are based on the latest, well, no doubt. I'll be redundant here. They are improving their chart here. We, of course, don't read it as much. The UK trade deficit widened to 3.4 of normal GDP. That was inflation of real adjusted prices there. And something about the methodology, you can read that, and this does it there. And let's roam along here a little bit. BBC Business page. We'll just go back here and make sure we got the latest, and we'll do the numbers. Uber, their shares are shrunk here. Let me just get the old Uber story up here. They fell on there. Their shares were down 7.6 on the first day of trading, and they opened up there. The boss, Darren, oh boy, I won't even try to pronounce his name. By the end of the session, shares were at $41.51, below the company's listing price of $45. Uber sold 180 million shares at $45 each, raising $8.1 billion of cash and valuation of 82 billion. That is 63 billion pounds. So in other words, if you went in at 45, you were down to 42. We'll see. Shares now traded under the symbol UBA. That's in the U.S. anticipating a debut of, anyway. Bigger challenges ahead for Uber. Michelle Fleury birdied on the first day there. That's usually not a very good sign. The biggest stock market debut in America in 5 years had raised questions about how companies like Uber should price their initial public offering, a particular challenge for money-losing tech startups. Keen to avoid that fate, Uber underwriters priced it at the low end of $44.50. No doubt firms like WeWork and Slack will be taking note. I assume, no doubt about that, they will be taking perhaps more than a note. Uber, there was a time when all of these particular setups were over $100, $150, $160 in their initial openings, that is, and usually you'd see some growth there. But is it a cheap stock? That's interesting. We don't usually get into that in macroeconomics. Let's do the market, so it's something safe to do. The FTSE 100 0.41 stood, and in Amsterdam they were at 0.66% there in the green, in France at 0.76. These are the percentages. The change in the FTSE was 29.47 in Amsterdam, and 3.65 was the change. I guess we'll do it that way. The DAC at 1.08% there, or 129.87. That's the change. The Eurostrasse at 26.23. In Madrid, they were at 67.50. The percentage change was 74% there. On to Bombay, they were down negative 95.29. The Hang Seng in Hong Kong at 239.17. The Nikkei was down negative 57.21. And let's head back to New York. The Dow was also down 138, 0.97. The Nikkei was down 32.73, and the S&P 500 was down negative 8.70. And let's Brent crude futures, 56.56 cents effectively, at $70.95 or $70.95. West Texas crude at $62.14, a 44 cents change. Tipo picking in his retirement, still jumping for joy, cartwheels and everything. Gold was down 3.65, resting at $1,284.10 on the Forex. And that's all we have there at the BBC. And where are we? Well, we're about where we normally are. Anyway, nonetheless, the markets will be volatile until they see something on the U.S.-China trade situation there. Is it going bad? Well, many times in these negotiations, things look bleak, and then all of a sudden there's a compromise solution. It's difficult here because there's so many things that are being covered, more than price. You're dealing with things like intellectual, what they call theft, and that's done by all governments, all places. Corporations have been doing it since time immemorial. And then there are other things, access to the market, and the access to the U.S. Access to the U.S. has actually been more difficult for Chinese firms. If you look at Huawei and their problems of having access with many would say a superior product. And that is one of the things you'll see in the coming months and years as there is more equity in the amount of knowledge out there, knowledge accumulation, and there is more parity in these situations. And you'll see technology such as 5G and various other things that nations that have not been in the game will be in the game, and very, very quickly. And that will even go to some of the emerging nations, Kenya, for example, that is now starting to get into AI, artificial intelligence, machine learning. These are skills that can be taught at university, and they're being taught online, so people can access those situations, and the low cost, basically, once you access them with compilers and what have you, you can actually write the code on your workstation, PC, or whatever you got have there to do that, and you have access to things like R, and much of the tutorials out there, lectures from the likes of MIT, etc., are online. And then access to textbooks, and some of those are PDFs, some of those recordings, audio books, various things. So there is more access to this knowledge, and like all knowledge formats, once people start to dig deeply into it and start to build these various programs, their knowledge and creativity usually not associated with knowledge, but we'll say that it's particularly in some design things like Android development, or that sort of thing, they will get better at it, and there will be breakthroughs. The same way on the hardware side, as we get more standardization, open source hardware. We'll mention this in this report, because here at WBRN and on the Bostonred Network, we try to do more than one thing in all of our broadcasts. But we do in fact do that, and as we see more and more open source type software, as opposed to proprietary software, or partially a hybrid proprietary software, we see that in some of the software offerings, say from Google, and definitely Microsoft is more or less all proprietary, and so is iOS or Apple type software. But when we see the so-called cloud of these data center type of setups is becoming more often open source, because they're using Linux. Now there may be some closed source things. I don't want to get too much into programming here, but those are not the way to go in terms not only of flexibility programming or development. Being a developer myself, we see a lot of that, but in terms of cost, you don't have to remanufacture your mousetrap. If you have an open source software under an open source license, you can take it down, look at the source code improve it, and depending on what license you're on, give it back to the community, or you can keep some of it. It depends on all those licenses there. But that you don't have to go back and get the mousetrap. You will have a mousetrap, and you can have an improved mousetrap. Cost is less. It also opens up more of a level playing field for new developers, particularly in emerging markets, that it can be done much more cheaper, because you have the basic source code and the ability to work in languages like Python. I don't want to get too much into programming here, and various others, Go, you name it. There's all these languages, but there is tutorials available online. And this has an economic impact, because what we're talking about here is sustainable development in both hardware, software, and that goes into such things as we were looking at a BBC, or listening to a BBC report about seeds in some countries where people are working on various types of seeds, sustainable agriculture. and from everything from sustainable agriculture to various insulin pumps have been hacked, and going to open source types of the insulin type pumps. The whole idea is to open this stuff up, because if it's opened up, you decrease the costs. And given the economic scenarios we presented here today, cost containment is very, very important, and so is productivity, and this all increases productivity. But disruptions are caused by things like Brexit. That's on the political side, not on the economic side. The trade war, which has become a part of the Trump administration's political agenda, and is now warped into an international, global agenda, and that can cause all kinds of problems out there, particularly for countries that are dependent on Japanese imports. And in many of this goes to the supply chain we talked about. There are many components in a supply chain that can only be sourced from China at this point in time. But yes, some of that is moving to Vietnam. Some of it is moving to other countries. They even named Bangladesh there. But it takes time to make the move. And as that moves along, you'll eventually have some situations with Vietnam. So these are some of the things to remember there, that while they figure things out in the UK with Brexit, they have till October now to figure it out. And in the US here, with the Federal Reserve, will interest rates be cut, or will interest rates be increased? One thing on interest rates, if as core inflation, if it goes over 2%, expect the Fed to raise interest rates. And they're correct on this, because you have such an unpredictable economic setup. But you're going to see eventually price rises because of these tariffs on goods, and that will be any goods that are coming in from the day on or yesterday on, whenever it was. Ones in the pipeline, it won't raise on those, but when you start talking about those rises, they will eventually be passed on to consumers, and some companies will, as they say, make a preemptive strike and pass them on now. So you'll get some things, particularly electronic components, going up. And as those finished product move out of warehouses and on to the retail levels, you start to see those prices go up. And as those prices go up, you start to see inflation going up. So that is our end keynote here. For those in business, make next week a productive one. And for the consumer, obviously the eye on the price. And in the U.S., we have what's called Mother's Day. Happy Mother's Day to everyone. We don't usually do that sort of thing here, wishing people a happy Mother's Day and various other days that they are. But later this month in the U.S., we run into something called Memorial Day. In many nations, we have Boxer Day and etc. That there are holidays and activity tends to cease. So those are realities of everyday life. But what we are seeing, more and more things that are on the political side, in the economic sphere, much more. They were always there. Political economy, obviously, very big subject matter. But now, for everyday people, we see that more and more in their lives, period. Such as the big debate in the U.S. over health care, Medicare for all, a new way of dealing in terms of a national health care system here in the U.S. That'll be in the 2020 campaign. Hear much about it, period. Good day.